Did you know that 90% of investors lose money in the stock market? That's right, most people think they can get rich quick, but the reality is far different. In fact, a study by Dalbar found that the average investor's annual return over the last 20 years was just 2.6%, while the S&P 500 had a return of over 7%. The difference is staggering. Why does this happen? It's because many people make the same mistakes over and over. They chase the latest trends, buy into the hype, and ignore the fundamentals of investing. And in doing so, they guarantee one thing: they'll never get rich. In this video, we'll uncover 6 surprising signs that might be holding you back from true wealth. We're not talking about typical advice here. Instead, we'll dive into the real reasons why so many fail at investing and what you can do to avoid these mistakes. Stick around to learn how to escape these traps and start building lasting wealth with value investing. Ready to find out if you're making these costly errors? Let's jump in. Chapter 1. The FOMO Trap. Chasing quick gains instead of lasting wealth, FOMO, or the fear of missing out, is one of the biggest traps in investing. It's that nagging feeling that everyone else is making money, and you're missing the boat. This feeling often leads investors to make impulsive decisions that chase short-term profits, like jumping into the latest tech IPO or hot stock. But here's the truth: chasing quick gains is a dangerous game. Most of the time, these investments don't last. For instance, remember the dot-com bubble in the late 90s? Investors flocked to tech stocks without understanding the companies behind them. They saw the skyrocketing prices and thought they had to get in, only to lose everything when the bubble popped. Warren Buffett, the king of value investing, once said, "The stock market is a device for transferring money from the impatient to the patient." Patience is key in value investing. Instead of getting caught up in market hysteria, value investors take a step back and ask, is this stock truly undervalued? They look at a company's long-term potential, not just its recent performance. A key strategy here is to focus on intrinsic value, what the business is truly worth, based on fundamentals like earnings, debt, and future growth prospects. For example, Buffett made a fortune by investing in companies like Coca-Cola, not because of short-term market trends but because of their enduring business models and brand strength. It wasn't about jumping on the bandwagon, it was about finding companies with sustainable value. Studies show that long-term investing outperforms short-term speculation over time. A report from Fidelity found that the average holding period for a stock is now just about 5 years, down from 8 years in the 1960s. This shows how quickly people jump in and out, often missing out on solid returns from stable companies. If you find yourself looking at the latest market fad, take a deep breath. The real money is made by staying grounded and investing in businesses that have a proven track record. Remember, value investing isn't about speed, it's about building wealth gradually, with discipline and patience. Chapter 2. The perfectionist syndrome. Waiting for the perfect stock. Many investors fall into the trap of waiting for the perfect stock. They think they need the ideal combination of low price to earnings, P/E ratios, growth potential, and perfect market timing. But this often leads to inaction. The perfect stock doesn't exist. Warren Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This mindset teaches us that waiting for the perfect deal can cost you time, money, and opportunity. Think about it. The stock market is unpredictable. If you wait for everything to line up perfectly, you could be waiting forever. The reality is, waiting for perfection often leads to paralysis by analysis, where you're so focused on finding the perfect stock that you miss out on opportunities altogether. Take the example of Amazon. In its early years, many investors considered Amazon overpriced. Its P/E ratio was sky high, and it wasn't making consistent profits. But those who passed on Amazon because it wasn't perfect missed out on some of the most incredible stock gains in history. Value investing is about finding solid companies that are priced lower than their true value, even if they're not perfect. Focus on businesses with strong fundamentals and a clear path to growth, not the illusion of a flawless investment. A great strategy is to look for companies with strong cash flow, a competitive advantage, and a management team you trust. These factors give you the confidence to make smart decisions without getting hung up on finding the perfect stock. Chapter 3. ignoring the business behind the numbers. When cheap isn't really cheap, it's easy to get excited about a stock that looks cheap on paper. Maybe it has a low P/E ratio, or its stock price has dipped recently. But here's the reality: cheap doesn't always mean good value. A stock might be trading low for a reason. For example, the company could be struggling with massive debt, declining sales, or poor management. When investors ignore the business behind the numbers, they risk buying into a sinking ship. Buffett warns, price is what you pay. Value is what you get. A low stock price doesn't always equal value. If the underlying business is weak, that cheap stock could end up costing you a lot more in the long run. This is why understanding the fundamentals of a company is crucial. A company with strong revenue, solid profit margins, and a strong market position is much more likely to deliver returns in the future, even if its stock price is higher. Look for businesses that have competitive advantages, like a recognizable brand or a monopoly in their sector. Take a look at Ford Motor Company in the early 2000s. The company was trading at low prices, and many saw it as undervalued. But when investors dug deeper, they realized the company was facing immense challenges, including heavy debt and stiff competition. In the end, Ford's stock price didn't perform as expected. The lesson here is simple: don't fall for the trap of buying a stock just because it looks cheap. Dig deeper into the company's financials. Are they profitable? Do they have room to grow? Are they in a strong position to weather economic downturns? Answering these questions will help you separate genuine opportunities from value traps. To become a successful value investor, always look beyond the numbers. Focus on the quality of the business and its potential for long-term growth. And remember, just because a stock is cheap doesn't mean it's a good deal. The true value lies in the company's fundamentals, not just the price tag. Chapter 4. The emotional roller coaster. Letting fear and greed control your portfolio. Investing is often an emotional roller coaster. When the market is high, greed can make you take on more risk than you should. When the market drops, fear can make you panic and sell at the worst possible time. These emotional reactions can ruin your investment strategy and cause you to make irrational decisions. Value investing, however, is about emotional control. It's about sticking to a disciplined strategy and not letting short-term market movements dictate your decisions. As Buffett says, be fearful when others are greedy and greedy when others are fearful. This mindset allows you to buy undervalued stocks when others are selling out of fear, and sell when the market is overly optimistic. Research shows that emotions are a big factor in investor losses. A study by Dalbar found that investors who let emotions control their decisions can see returns that are 6% lower than the market's average. Staying calm, patient, and rational will help you avoid the costly mistakes that many investors make. Chapter 5. The know-it-all mentality. Overestimating your stock picking skills. Many investors think they can consistently pick winning stocks and outperform the market. But this overconfidence can lead to major losses. Studies show that most professional fund managers don't even beat the market. The S&P 500 has outperformed the average actively managed fund over a 10-year period. Buffett is known for his humility. He says, the most important quality for an investor is temperament, not intellect. You don't need to be a genius to succeed in investing. What you need is the discipline to stick to a strategy and the patience to let your investments grow over time. A great approach is to learn from others, read extensively, and continuously improve your investing skills. But never assume you have it all figured out. In the world of investing, the market is always changing, and there's always more to learn. Chapter 6. The Time Traveler. Focusing on past performance instead of future potential. It's easy to get caught up in a stock's past performance. We see that a company has been doing well over the last 5 or 10 years, and we think it will continue on the same path. But this is a mistake. Past performance is no guarantee of future results. Successful value investors focus on the future potential of a company, not its historical performance. For instance, if a company has a strong product pipeline, a growing market share, or new leadership that's focused on growth, these are much better indicators of future success than past stock prices. Remember, the key to successful value investing is to look at the fundamentals and the long-term potential of a business. Don't be fooled by a company's past, it's the future that matters most. If you found these strategies helpful, don't forget to subscribe and hit the bell icon to get more insights on how to make smarter, long-term investments. This will help you stay ahead and avoid the mistakes that most investors make. Stay tuned for more.